Welcome to our weekly market review brought to you by ETM Analytics and TreasuryONE. As always, I'm joined by TreasuryONE's currency strategist, Andre Celia. And Andre, if we look at the headlines the past couple of days, one that has garnered some buzz in South Africa is Trump's latest threat that he will take action and impose 100% tariffs if BRICS countries continue with, creating this alternative reserve currency. Now, when it comes to a politician like Trump, it's always good to keep some perspective. Okay, we know the man is a big talker, so how much of it is really just talk, or does it hold actual water? And I think it's so important to just look at it from an analyst's perspective. For one, there are some speculations as BRICS countries, is it a policy that they have adopted yet to embark on the single currency? We know that there were some suggestions. We know Putin was pushing for de-dollarization. But other than that, replacing the US dollar as a reserve currency or enforced de-dollarization is something that will take years. So we can rule it out for at least the short to medium term. And thirdly, when we think of another currency that can replace the dollar, one tends to think perhaps of China as a possibility. But even that, it will, when we look at it fundamentally speaking, China will have to change its entire economic model to enforce de-dollarization to an economy that runs a trade deficit to export its currency to the rest of the world. So a lot of buzz, a lot of craze around it. In reality, a lot more challenging than what it sounds like.
Yes, a lot more challenging. But when I grew up and I was at school, there was only one form of punishment, and it was called 6 of the best. And when Donald Trump opens his mouth at the moment, there's just one punishment. I'll slap you with tariffs. Will it come to fruition? I doubt it, because slapping all these tariffs doesn't do all that well for his economy either, So, but be that as it may, we've spoken about de-dollarization a few times this year. It's being brought to the front over the last 2 years already. It's only now that there's a new president that he lifts his finger about everything. And as I say, 6 of the best is I'll slap you with tariffs. This is going to take years. You mentioned it already. So I don't think it's going to have a dramatic impact at this point in time. All he's done is lifted a finger.
Exactly. But as this chart suggests, we can't say necessarily the same for the euro, right? It's struggling a bit.
Yes, but now, is the euro struggling because of de-dollarization, or is it struggling because that economy is simply just in a struggling phase? Parts of Europe, if you look at their demographics, it's an aging population. They've been battling, they've been more and harder hit by the Ukraine-Russian war with the increase in cost of gas and the supply of gas and everything. So the impact there was much greater, and the uphill that they've had much bigger. A country like Germany, big in the car manufacturing, getting uphill from the Chinese with all the Chinese cars, not just in South Africa, throughout the world. So there's structural things that's wrong in that European economy, and they're struggling as such. So the slightest little thing that comes up at the moment hits them harder. But it's not all just because of the word de-dollarization or anything. It's inherent a weak economy at the moment in Europe.
they're struggling quite a bit. Germany has just created this problem where, especially the car manufacturers, where they've simultaneously become overly dependent on the Chinese market for their revenues, but also being undercut by China in the global market when it comes to vehicles. So they face very real problems. And on top of that, we know that there's some political chaos going on, a lot of snap elections and a lot of infighting happening in the EU. So it's going to be, I think, a tumultuous time for the Euro bloc heading into 2025. But just bouncing back to the US, because that's the data we will be looking out for this week, is Friday's labor data coming out. And obviously, we are going to take this into consideration to see how we look at the interest rate outlook for next year. I have to say, the last data that came out with the 12,000 jobs that they added, when I looked at the data at the non-farm payrolls, I for a split second thought that they made a typo in the data that came out, because it was quite low. We're obviously expecting a bit of a rebound in the latest figure coming out this week, and that could set us up for interest rate cuts for the next year coming from the Fed.
Yes, the data is getting a little bit erratic and sometimes lifts an eyebrow. But cyclically, we are going into their winter period. So the hospitality industry and so forth could shed a few jobs and not employ as much. So we could expect most probably a little bit of a hiccup in the figures. We must remember that when they come out with a new figure, it's an estimate, and then there's the revised number for the previous month. So it is expected that the revised figure for that low 12,000 could come in a little bit higher. But because of the time periods and so forth, we could possibly see that there is a bit of a slight increase in unemployment, lower creation of jobs. And going forward, we must keep in mind that currently there's a ceasefire. Donald Trump this morning or yesterday said, if you do not release the hostages there out of Gaza before I proudly become the president of the United States of America, all hell will break loose. And we will hit you harder than you've ever seen in the history of the American history. So things that we must watch closely. I think he might ease off a little bit over Christmas. Let's hope for that. And make less threats and lift less fingers, fewer times. But we should watch this space quite closely. For the moment, still cuts priced in by the Fed. And I think we still see the 25 basis points at the upcoming meeting, and then go into a calm period over the Christmas period. And then we'll wake up to turmoil again, most probably in January.
Come 5th January, everything just gets uprooted and uplifted, and we have to gear for another rough year. But as we start winding down 2024, what's the Rand doing?
Well, it's gone slightly above the 1830, came right back below the 1830, closer to the around the 1810s now. So I think 1830, I still regard that as stoppish, and I'm still very happy that we're in very neatly in the 1730, 1830 band, and we will remain there till middle January when things heat up again, and then more stuff would be released out of America, more impact would be seen. We will see where we go with wars, how many times they've breached the ceasefire agreement between Lebanon and Israel over the 2-month ceasefire period. But for the moment, 1730, 1830.
That's it, Andre. Like I said, we're starting to wind down 2024. So next week will be our last market review before we both take a breather and prepare for what is going to be an interesting 2025. I'm not going to say tumultuous. I'm not going to say volatile. I'm not going to say any of those words. I'm just going to say it's going to be an interesting 2025. So I will catch up with you again next week.
Thank you very much.